Okay, let's continue with corporate conversations as we keep dissecting more earnings. Indegene is the next company on our radar. The revenue came in line with the estimates, but there was a miss on the operational front. We have with us Suhas Prabhu, Chief Financial Officer at Indegene. Thank you very much for joining in, Mr. Prabhu. Good to have you in. So your top line growth, I think, was as much as 17%. However, margins from about 18.5%, you've come down to 16.5%. Why was this 200 basis points compression at the EBITDA margin level? What were the factors at play? And is it a one-quarter phenomenon? And can you give us some visibility on H2?
Sure. Thanks, Surabhi. So, as you rightly observed, 17.1% growth in the revenue. Coming to the margins itself, we had a couple of transactions that closed in October. From an M&A perspective, and we had certain non-recurring, non-operational costs in relation to the transactions that we closed, such as diligence and legal fees, which has impacted the margins for Q2. But given that these are non-recurring, we expect that to get back going forward.
So for the year, what kind of numbers should we work with regard to revenue growth as well as margins?
The revenue growth for H1 has been a healthy 14.8%. We remain bullish given the kind of pipeline conversion as well as growth in a pipeline that we see, and are hopeful of beating our last year's growth rate as we look forward to ending this fiscal year. On the margin front, given that there would be a negative impact of the M&A kind of expenses, though non-recurring in nature, on a full year basis, this might result in a slightly lower growth on the margin front compared to the growth rate on the revenue front.
So can you give us, some indication, even a rough band would do? I mean, will you end the year also around the current 60-odd%, or will it be a little better than that?
At the EBITDA level, I would say we should be a little under 20%. And last year we did around 19.6%. We might be a little lower than that.
All right, we hear you. But what about the deal wins? You know, the first quarter you got a bunch of $3 million average contract values. What have those wins been in the second quarter, and what's your prognosis here?
Yes, very encouraging second quarter. We had 2 deal wins north of $3 million in ACV, and 4 deal wins in the $1 to $3 million range, which is improvement on the large deal wins compared to Q1. The encouraging part was that during Q2, we had our first breakthrough in a tech implementation deal with a young pharma company, as well as a pharmacovigilance deal, which is actually a multi-year contract with a med devices company. So these are encouraging signs for us.
All right. I wanted to ask you about a segment which is smaller, less than 10% now, the brand activation. That's degrowing. When does it get back to its growth base? If you could help us out with that, and also give us a little bit color on the Gen AI initiatives. How are they panning out, and what should we be looking at in the time to come?
Sure. So the brand activation business has seen some headwinds with a couple of projects coming to a close, but we are looking forward to growth coming back in the segment given the pipeline that we are carrying. But more importantly, while the brand activation business, largely coming from an acquisition that we had done in the past, Cult Health, was focused on a brand-by-brand engagement, which sees some bit of natural churn. What we have also done is transformed this capability to be integrated with our enterprise commercial business with a new offering called as Tectonic, where we are seeing the growth. So, one way of looking at it is not just on the standalone, but a rub-on effect on the business as a whole. And that is also the positive that we are carrying from the capabilities that we have in brand activation, having a rub-on effect on the enterprise commercial business of Indegene.
Right. Just to wrap things up on the revenue front, you said that your revenue growth will be a lot higher this year than what it was last year. I just wanted to understand how much higher. Why do I say that? First half, you grew with 14.8%. All of last year, your revenues grew by about 9.9%. So you're obviously much higher at the halfway mark as compared to last year. By the end of this year, what kind of outperformance do you anticipate?
While we refrain from giving any specific guidance, even on an organic basis, we are bullish to be able to get into the range, which is what we are operating at on a year-to-date 6-month basis. And combined with the acquisitions, the inorganic growth rate should go north of 20% for the whole year.
All right. Thanks a lot for joining in. With the acquisitions, the growth rate this year should be north of 20%. We get that enough clarity.